Hey, good day, everybody. It's Finance 3303, spring semester 2025, and this is the recording for Chapter 8. You could see bond valuation and risk. I was waiting to record this one. I recorded the other ones in advance. The other ones were less mathematical, and I just wanted to gather some things and do this one last. And guys, as far as the bond valuation, I think you've seen this in other classes. I'm not going to spend a lot of time doing bond valuation. 3300 requires it. I know my class in 2302 we do it, and some other classes do it as well. But I want to say on the front end, um, this discounted cash flow model, or DCF, is really used in a lot of finance applications. And finance people get unusually animated. I mean, it's just an excitement when money changes hands. And that's true in banking, that's true in finance, it's true in brokerage, just about everything that's centered around finance. Um, it's made more, seems like more dynamic or more drama filled, if you will, when money changes hands. So, taking a little bit of an example, every time you pay your cell phone payment, well, that's once a month. Let's say it's AT&T. AT&T gets your money, and then what happens between one payment and the next payment? The answer is nothing. You keep using your cell phone, and life goes on until your next payment. Well, that's when they would value if they want to do anything with your account or anybody's account or something in their corporate network. They would value that cash flow and they would present value it back to today. And then, so that's the valuation. Okay, I'll show you some things that are in the chapter. So I'm going to try to keep it brief and not really dwell on the math, but that's what this is. The chapter 8 is the math. The risk is what has happened, and this is going to strengthen our knowledge for chapters later, like I think 17 or 19. Guys, the risk is, have interest rates changed? And the answer, I'll just put a dot there and say, no, they haven't changed. Or the interest rates have gone up, or the interest rates have gone down. And then how much did they go up? How much did they go down? So right here in 2025, we saw a couple of years ago, the Fed raised rates by an excess of 5 percentage points, and they did it with a fairly swift pace. So it wasn't that just the rates were going up, they were going up by an amount that we hadn't seen before in decades. So you had a lot of financial institutions' websites, and I know I work at one, and I mean, it just makes a mess. So the risk, the interest rate risk, I can't emphasize that enough. And the calculations that go on here try to address that. So if interest rates are going up, well, your bond portfolio is falling, but your reinvestment risk is increasing, meaning every payment that comes in, you could reinvest it at a higher interest rate. So, but it's, your bond portfolio has fallen significantly. And the United States had, bank failures, big bank failures. The one that Silicon Valley Bank, if you want to Google that and see what happened to them, uh, it was like interest rate risk. They had a lot of deposits with large balances, tens of millions of dollars, way past the insurance limit, and people started taking their money out. Well, okay, that's fine, but it usually blows through your liquidity. Let me erase this. So first somebody comes in and asks for $1 million. Okay, I'll take care of it. I'll wire the money to you. Where's it going? It's usually not going in a paper bag so you can put it in the trunk of your car. It's being wired out or transferred to some other account that somebody had. And okay, the $1 million goes out, and you keep a level of the balance sheet liquid for things like that. But imagine that the liquidity starts to get thin and you start running out of money to wire out. So what happens when the next person comes in? Well, generally, you go to your investment portfolio. I mean, there's some things that we can do. And we learned in previous chapters financial institutions can do things that we can't do. They buy a bunch of T-bills, or they do reverse purchase agreements with the Federal Reserve, stuff that a regular person can't do. So those corporate accounts can get kind of um, they get kind of complicated, and it's only aimed at the corporation. But if interest rates have gone up and the bond portfolio has come down and you've burned through a lot of your liquidity sources, well, then you start selling bonds. So let's say you had $1 million bond at 1 million, and now it's at 800,000, and you sell it. Well, where's that $200,000 loss going to go? Well, that's going to show up as a loss. So you take enough of those losses and you got a business. It's that simple. So that's what was going on this last cycle, and of interest rate risk, and it's a killer. It could be catastrophic to a financial institution, and it's just how was your balance sheet set up, um, and how were your cash flows expected. And then last but not least, on the interest rate risk side, if the rates go up enough, driving the value of your bonds down, that process would be mitigated if you had short-term bonds. If something is maturing out 30 years, you could expect this huge difference when you do your bond valuation after the rates have increased. If you have something due next week, you don't really have much to worry about. It's going to mature at $1,000. It's going to mature at the face value, and then you could use it to create some liquidity. But in the most severe cases, like the Silicon Valley Bank, what happened to them? Well, they ran out. They were running out of their easy sources of liquidity. Then they ran out of their more difficult sources of liquidity, and I mean, it killed the bank. It killed the bank in 1 week. It was amazing. So if you choose to, Google that, and they'll have some things on the internet. Something you may find interesting is all of you are finance majors. All right, so the bond valuation process. I don't want to skip this completely, but I just want to talk about it in words. So the present value of a bond, guys, right here. Sorry. So the present value of a bond, this is 1 plus I to the minus n. And when you use it on the denominator, you don't have to put the minus there because it's already on the denominator. So you're taking the present value of each coupon all the way out. That's what the dot, dot, dot is, as long as the bond's out there. And you get your last coupon, and then, of course, the par value matures. Usually a corporate bond's going to have $1,000 par value, if you all are remembering that. But the semi-annual coupons, they could be annual, semi-annual. Most of them are annual. Excuse me, most of them are semi-annual. And when you take the present value, you have what the bond's value is. So what happens is, when under that interest rate risk, I mean, this would be at par when the bond is first printed or first being made available to the public. But that interest rate risk is going to increase K, okay? And this would be the required rate of return. So if you bought an 8% bond, it's paying you $80 a year, and interest rates go up to 9%, guys, what's going to happen is the required rate of return is going to go up to 9%. So you increase that rate of discount, and it's going to drop the bond price. It's going to drop this present value, because now you have to price it in a 9% market. If you want to sell it, the buyer, assuming that they're awake, they're going to require the required rate of return that's existing in the market right now. So imagine if it went from 8, what's 5, to 13. Okay, that's what happened of late in the US. It was happening all around the world. So you put in a 13 right here at K, and you could see how that would just be absolutely catastrophic to a bond. I was doing some calculations in another class, and it's like a 30-year bond at 8%, and rates went up to 9%. The bond lost 10% of its value. Well, if you increase rates by 5 percentage points, well, you're going to lose, because the math will keep together pretty much. You're going to lose half of the bond's value. So the bond that you bought for $1,000 is now worth 500. some people would say, yeah, I'm just going to wait it out. I'm going to wait till I can cash the bond in at par, and I'm not going to lose a thing. Well, two things. You're going to lose the opportunity cost because you've got a 9% market or a 13% market. Everybody else is getting 13% bonds, and here you're still stuck on the 8%. So it won't be that you're not losing money. There's some opportunity costs there. And secondly, if depending on what's going on, if this is in your account, you want to treat your account like that, well, it's nobody's business. You could do exactly that. You could wait, let's get this straight. You're going to wait 30 years for the bond to mature. And some people stuck bonds, guys, in their IRAs, and it's like I'm 27 years old. I'm not going to retire until I'm 60. Boy, that sounds a long way away for a 27-year-old, but nonetheless, it's like I'm just going to wait till it matures. Okay. If you're working for somebody, or you're a broker, or you're working in the finance business, or you're an insurance company that says, no, I can't, maybe I can't wait. Maybe we have to move the money around. Maybe we have to cash some of those bonds in, a process that I just described, and we're going to take these huge losses. So that's where, some of this other stuff, you'll see it toward the end of this semester, at the end of this chapter, that is, you'll see more of what I'm talking about. But this right here, I just have to uh, emphasize that we have to understand that this is the present value. It's a discounted cash flows, and that is bond valuation. It's not hard for us because I'm sure we've been exposed to it. All right, I'll put this up here so it captures it in the video, and then I'll go on to the next page. What they're doing is they're saying you got $1,000 bond that pays $100 at the end of every year for what, 3 years. So there's the present value, the present value, the present value of the three units of money, the three cash flows that are going to come in, and it's saying the bond is worth 951.97. So that's just a discounted cash flow, uh, present value back to today. All right, they're describing it here also, guys. Same story, right? It impacted the discount rate. That's what I was alluding to. That K on the previous page. Let's go back and make sure let me just show that again so it captures in the recording. If the discount rate is moving around, now if it's going up, your bond price is falling. If it's going down, where the Fed is right now, ideally it's going to keep lowering interest rates. Then a brand new bond, if you bought it today, it would be at whatever rate that's stamped on the face. But if the Fed starts lowering rates, that's going to better your bond purchase because that price is going to start coming up. So bond prices and interest rates move opposite each other. So we would say they are inverse to each other. All right. So bond valuation with semi-annual payments. That's the same story, same math. You're just saying instead of having $100 of a coupon at the end of every year, you have $50 every 6 months. The math is the same. It says the present value with semi-annual payments, and you do have to adjust the interest rate. You have to keep the compounding interval the same as the coupon payment interval. And that's what keeps the math straight, but it's the same story. Don't have to spend very long on that. It's the exact same math. Okay, so here's what they're doing here. Okay, same story. If you let that sit, it'll be recorded if you want to turn back to it. All right, I have just explain this. Bonds that sell at a price below their par value are called discount bonds. That means that bonds that sell at a price above their par value are premium bonds, the ones that are sold at a premium to face or a discount to face. And that's where somebody, after the rates had gone up so much, you had some people going in and buying bonds that were in a deep discount to their face value. Again, the face value being 1,000, interest rates went up by 5%. If bond prices fell by a large amount, somebody's like, look, I'm going to pick up some of these bonds at $500, and then they're going to mature at 1,000. So that's a conversation worth having if you want to be a little bit entrepreneurial about things that happen in the economy. But that's what that is telling us. All right. All right, so explaining bond price movements. I'm just reading this, just read along with me. As explained earlier, price of a bond should reflect the present value of future cash flows, coupon payments, and the par value based on the required rate of return, whatever the market interest rate is. And it's K in this book. And they go on to say, so that since a required rate of return on a bond is primarily determined by the prevailing risk-free rate, which is a yield over a treasury bond of the same maturity. Um, what they're saying here, guys, is a bond is determined by the prevailing risk-free rate, which is like on a treasury. And then they would add a risk premium if your bond was, let's say, issued by Microsoft. Microsoft isn't risk-free. It doesn't have a lot of risk. Microsoft has a very, very high credit rating, the highest actually. And if you went to Ford, Ford has a junk bond rating right now. So those are risk premiums that would go along with those purchases. You wouldn't have that same element. You wouldn't have a risk premium inside of a treasury bond. But I want to say that guys, that treasury bonds, somebody would say, well, there's a risk premium, the change in risk premium. Somebody says, well, I'm just going to buy all treasury bonds. They have no risk. Oh, they certainly have risk. They have interest rate risk. And they're not going to be immune from that. The math is going to affect the treasury bond. Arithmetic doesn't care. Your calculator doesn't care. If you bought a treasury bond or a bond from Ford, it's just going to be doing the present value of that cash flow. And if you got an 8% treasury bond and the market rate is 10, nobody's going to want you 8, even if it's a treasury. They're going to demand that you take, you sell it for a discount because interest rates have risen, and that bond should be sold at that discount. But it's not going to go bad. You're going to get paid, but you're still going to have that difference between the par value and what the bond value if interest rates changed on you, changed to the worst, meaning if interest rates rose. All right, so we've been going through a lot of inflation over the past couple of years, and that gets baked into the cake. So if you've got inflation coming into the economy, that's going to push up the required rate of return in most cases for bonds out there, because somebody's going to say, wait a minute, if you're issuing a 6% bond and inflation is at 6%, well, my real rate of return is zero. What if you were issuing 6% bonds and inflation went up to 9% like it did 2 years ago? Well, then you're going to get a negative real rate of return. Real meaning when an economist says real, it's pricing in the inflation expectation. So we have to remember that while we're studying this material. Okay, economic growth, guys, that could be, interesting. We're in a growing economy right now, and people are wondering, where the economy is going to go. We got a lot happening on the government side. If strong economic growth tends to, like the first sentence here, tends to put upward pressure on interest rates because the economy is expanding, and the demand for money might be expanding, and then the interest rates in consequence might be expanding. So you've got, when people start pricing 10 and 20 and 30-year debt instruments, they do the best they can to add all of these incremental changes to produce the right coupon payment or the right coupon rate that's going to produce the payments. So that could be, that interest rates could start going higher again, depending on if the economy starts growing. It's like, well, how fast is it growing? And that might alter the rates materially. All right, money supply growth. Usually when the Fed increases money supply of loanable funds, that could increase the demand for money, and the same process would happen back here with economic growth. And what I'm saying on this video, we have to be asking ourselves, well, if the economy is strengthening and interest rates may be going up, guys, the opposite would be true. What if the economy was weakening? Well, then interest rates, the expectation would be that interest rates might start moving down. Same thing with the money supply or any budget deficit. We talked about the supply and demand of loanable funds in previous chapters. Well, that's what is going on here, but we're just talking about rates and not necessarily the amount of money per se. All right, the factors that affect the default risk premium. Well, this is really covered in a previous chapter, but changes in the credit premium on the over time. I think we all know, but in case we don't, let's make sure. You have bond ratings that go from a triple A, that's like a Microsoft, and all the way down to a D. So we have triple A and double A and single A. That's in the A column, and then you have triple B, double B, and single B. And then you have, excuse me, then you have the C's being a little lazy and not writing the other two. But these constitute investment grade bonds, guys. All this one, two, three, four categories investment grade, and these are junk bonds, or they called speculative grade. So Ford right now is at a double B, which is a junk bond, and all of these are at investment grade. Well, changes in the credit risk premium over time. What if your company, Ford wasn't junk all its life? Ford was up here in investment grade, and since the credit crisis, it's had so much trouble. Well, what happens if you buy a bond and the company's grade A? What happens if it drops to double B? Well, the changes in the risk premium in the default risk, like credit risk, that is going to increase. When you try to sell that bond, what you're going to have is a downgrade, and the price is going to fall because the chance of the company going bankrupt had just increased. And it might be that Ford could probably sit at double B for all our lives, and they're not going to default on their bonds. They're going to pay when the bonds mature. But it's when they are pricing debt to borrow money, Ford's going to pay a lot more for money because their credit rating has reduced, and just the opposite when the credit rating has increased. So you add, right around the 08, 09, guys, look at what happened. You had Treasury bonds, and you see in this graph, let me point this out to us. You see in where the treasuries shrank because the premiums were, excuse me, the bond price was going up and they were selling for a premium. How come? Right in the middle of the credit crisis, nobody wanted anything but treasuries. So they were buying treasuries very aggressively, and the increase in the price lowered the yield. Okay, so they were trading at what is this? About a 4% yield. And then right around the credit crisis, it might have been a 2.5, 2.75%. At the same time, they were selling out of, look, this is investment grade. These aren't junk bonds. And look at the required rate of return that increased so dramatically. It went from investment grade, went from about, my line isn't straight, about 7, and then they were adding up to about 9. So they were buying here, driving the rate down. They were selling here, driving the prices up and the required rate of return up. How come? Because everybody was worried about credit deterioration. People were worried they weren't going to get paid. So when the economy is functioning well, you have the spread between these two lines that is fairly predictable. They move in concert with each other, but this one moved opposite each other because we had a very aggressive recession right here that was making a mess of the financial markets, making a mess of the credit markets. It cleaned up. Look what happened after it. Let me erase this. Look what happened after it. After the recession ended, you still had some volatility in the markets, but it eventually, it kind of got themselves back to it being a parallel. Well, back when people could trust what they were buying at rates they were buying and at prices they were buying. Okay. All right. We don't need to look at that. Okay, I'll pause here, let it capture in the recording, but this is just explaining with a fancy diagram, what pressures are levied against a bond price. That's from the Federal Reserve, as you can see. Implications for financial institutions. That's what I was talking about in the front of the recording here, guys. It's very destructive. And when we had what's called systemic risk, that means that all of the water is polluted, so to speak. And it's systemic risk, it's systemic throughout the entire market or the financial system. So that was a big deal, and that's what was happening. And the only thing that made people happy was owning treasuries, like I described a page or two ago. Okay, the risk was systemic. All right, so guys, this is we're moving into a little bit deeper end of the pool here, and I just want to pause long enough to explain this well. So the sensitivity of bond prices to interest rate movements. All right, we talked about bond price elasticity. So it's a percentage change. If somebody was really doing a geeky experiment here and saying, what is the percentage change in a bond price given a percentage change in the required rate of return? Well, we talked about it earlier in this recording. And that's why I was saying when the Fed was raising rates and now they're lowering rates, you could go back and do the math, and people do. And for those of you who want to work in finance, you might have a little project at work by saying, I need to do a little work. I know there's a senior accountant in my office. He had to do work for the CFO. And it's like, okay, what happens to some of our investments when interest rates are expected to change? And guys, even when they're not expected to change, I think I'd mentioned to us on another recording. If not, let me explain it now. It is a law, okay, that I have to take, let's say, a zero bubble right here. I'm going to say this is no change. And let's say a interest rate is 6%. Well, I have to take my bond and say, what will the price be if interest rates fall by 1 percentage point or 100 basis points, 200 and 300? What will be my bond price if the interest rates increase by 1, 2, and 3? So not only do you have to do a calculation on where do you think your bond prices are going, better yet, or your portfolio is going, because you're going to have all different maturities. You're going to have something that maybe you just bought that's maturing in 30 years. You're going to have something that might be maturing in 30 days. So you have to do 6 calculations for every bond that you have and say and you could do supplemental test. We do supplemental tests sometimes, and we say, well, if interest rates go to 400, that's what these 3 are required. These 6 are required by law, but then you'll have companies that do supplemental tests just to see what that looks like, and you pacifying the examiners that want to look over your shoulder. It's like, no, we make sure we do more than what is asked of us just to see where the portfolio may be going if interest rates move. Well, look what happened. Over this past 2 years, they went above supplemental tests. They went plus 500. So that's an uncharted area. By the time it got this high, that's when all the trouble was in. And then you had to do, now that's the new rate. So you'd increase your rate by 5%. What would that be? 11. And then you have to take that 11 and go up 1, 2, and 3, and go down 1, 2, and 3. So guys, it was a mess doing this when we had to do it, and that's a law. You have to see where those and you have unrealized losses. You have $1,000 bond that it might only be worth $400 on your books. Well, you didn't take a loss until you sell it, but that you have these huge unrealized losses that you have to report on your financial statements for everybody to see. I want to add something, guys, here while we're talking about this. A car loan, we have to do the same thing on a car loan. Well, that is like a bond that pays monthly. Somebody comes in and they say, I want a $50,000 car. Okay, that's all right. And at 7% for 60 months or 72 months, and we figure out a payment. So let's say, just for the heck of it, it's $1,100 a month payment. Okay. And these are the cash flows. So as interest rates are changing, or even if they're not, I've got to shock my bonds, but I also have to shock all the loans to say, what is the opportunity cost that I could be loaning money at a higher rate? I would do that when everybody makes a payment. I would try to loan the money out at the higher rate if interest rates are rising. But if you try to sell the loans, guys, it's the exact same process. And we have bought pools of loans, something I'll talk about in class, and we have sold pools of loans. And it depends on what the interest rates are in the economy, and it's going to be present value of the payments. Well, these are payments that pay monthly. So I want to get us for the first time, and I don't think in any other class you would have that application where it's always bonds, bonds, bonds in finance courses, but loans are fixed income securities in banking that have to be valued. That have to be valued on a quarterly basis. So you have to do all these tests. You got to do. I mean, we get people who do it with computers, but it gives you these unrealized losses in your portfolio. So it's a lot of work. That's what goes on behind the scenes. Not everybody understands what happens in the background in a financial institution, and that's just some of it. So the CFO's office is busy with that. All right, so here I'll pull this up so we can see some of the changes. If you want to see that, I'll leave it in the recording. But what I want to get down to the influence of coupon rate and bond sensitivity. Okay, so what's going to happen, guys? Let me see the influence of maturity and bond sensitivity. Okay, something that we talked about. I wanted to get to this point that I don't know if you've heard this word before. I taught 3300 for about 10 years, and I don't think we went through duration. I might have had to mention it. It might have been in one of the chapters, but duration, I can't overestimate how important this is. So I'm going to put a big star, okay? And what that means is we might have some test questions on it. But guys, it's the weighted average present value. Let me say that again, okay? The weighted average present value. And it is expressed in years. So what we're doing with duration, and I'll show you an application here in just a second. This is so important when you're dealing with uneven flows of money. Loans don't look like bonds, and bonds don't look like car loans or house loans. Loans to people pay monthly, bonds pay semi-annually. Loans to people pay interest and principal monthly. Bonds only pay interest semi-annually, and at the end of 5 years, 10, 20, 30, you're going to get all of your principal back. So that is very different in the cash flows, in the size of the cash flows. So you go through one more step, what I described just a minute ago, that up 100, 200, 300, and down, you have to measure the duration. How long is it going to take to get your money back? So if I loan $50,000 on a car and I've got these $1,000 payments, well, somebody might say, well, it's 50 payments. It's 50 months. Okay, well, not so fast. It's the weighted average present value. So the weight of each payment, 1,000, divided by the amount loaned out, 50,000, 1/50th, okay, that's 2%. And then you would take the present value of that and you would add up the column. I'll show you because I did one for us. And you would get the number of years it would take to get your principal back, your 50,000. Now keep in mind, a loan has interest in there that a person is going to pay. And the interest is in every payment or incorporated in every cash flow. Okay, so then that's got to be in your duration calculation. But guys, as far as bond valuation and stuff, that is important. But really, where it gets most important for a financial institution is duration. So let me show you. Sorry. You can kind of tell who took what courses if they've never heard duration or not. You all are taking this course, so you're going to hear it. Okay, so check this out. If you've got cash flows on the top line, okay, and you're going to have this weighted average. So I'm not going to go into the math. I want to show you better on a spreadsheet. So the duration of a bond with $1,000 par, 7% coupon rate, 3 years remaining to maturity, and a 9% yield to maturity. Okay, so you've got you've got some change in market interest rates that's higher than your coupon rate. So you're taking the coupon, okay, and you're taking the present value at the 9%. All right. So it's again, I want to say what you're calculating here is not dollars. This is how long it takes. Well, if it's just a 3-year bond, it's going to take the majority of 3 years to get your $1,000 back, 2.8 years. The rest would be, well, that's the cash flow that's outside of the $1,000. Now, if you did, I want to make sure we're understanding this, and another way to understand duration. The duration of a zero coupon bond is its maturity. So if think about it, a zero coupon is you start today, okay, and you go out, let's say it's 3 years or 30 years, and then you get paid your $1,000 at the end of 30 years. Well, what happens in between? Nothing. You don't get any coupons. There's no calculation there. So the duration of a zero coupon bond is equal to its term. Okay. So if you're saying the term is 30 years, what's the duration? It's also 30 years because that's how long it's going to take to get your bond to get your $1,000 back. Okay. So if you have some of these funds that have a lot of zero coupon bonds in them, and they're fighting some duration risk in there because everything pays off at the end. So if you had the duration of a portfolio, this is all they're saying, is on a weighted average basis. So you see that W in there? That it's going to be in this right here. Let me see where it says the W. Might have been on a previous page. Okay, I'll show you. I'll show you in a thing I calculated. Weighted average. There. Okay. In other words, the duration of a bond portfolio is a weighted average of its bond durations, weighting according to the relative market value. All right. So let me see if I can get. I'm going to pause this and switch screens on us. Okay, guys. There we are. All right. So what I did was I put together a spreadsheet because I used this years ago, and I put together the duration and loan duration at the bottom on the tabs. If you're seeing that, if it's capturing it sufficiently. But let's say you had a 10% bond that paid $50 every 6 months. Okay. And then at the end of 3 years, you're going to get the 1050 back. You're going to get the last coupon of 50 and you're going to get your 1,000. I had to have the present value factor. Okay, that would be the present value of $50 a half a year away. So I got that factor in there. And then the present value amount after that calculation was done. $47 is the present value. Then the weighted average of that to the 1,000, okay, of this to the 1,000. So the duration is the period here, half, times the weight. So here's your weight, here's your duration. And guys, remember, you take in all this is financial, all this is dollars and cents, really, and you're putting it into years because that's how long it's going to take to get your money back. So where does this come in? Let me pause on that and I'll explain to you a little bit better in a second. Let's do a 10% bond that's out there for 20 years. Okay, same story. I did an interest rate is 10%. Here's all your $50 coupons. I did the present value. Spreadsheets are wonderful for this. Okay, and over here is your duration. Same story as before. So this 20, let's see what we got here. A 20-year bond has a duration of 9 years. So it's going to be roughly half of its term is going to be its duration. That's when I could say at 9 years I've gotten my $1,000 back. And guys, think about it. You're just getting back to $50 every 6 months, so it's a long time. Okay, it's a long time before you get out of a 20-year bond. It takes a long time to get that 1,000 back. All right, so watch when we go to loans. All right, so here's a loan amount. Now this would be the calculated payment. That's your cash flow. I had $1,000 loan at 10%. The payment is $87 and 90, about 92 cents, and is 12, it's just for 1 year. Okay, so we're going to get a level payment that includes principal and interest. We're going to get that back every month. Okay, so here's the sum, and I have all my present values, the present value amount, the weighted average, and the duration. Okay, so it's roughly half of a 1 year loan. So in 6 months, because the payments are larger than a typical bond coupon, because they contain principal and interest. So this is a relatively fast duration. On a 1 year issue, it comes up in only a half a year. If I said there was a $25,000 car loan at 10%, the payments of 531, payments per year is 12. Excuse me, I did it for 60 months. Okay. Here's your payment. I've calculated that. Here's your period times your weighted average. So how long would it take to get my money back on a 5 year car loan? Less than half of its term. So guys, here's where it's going to bleed over into a later chapter. I'm going to say it now, and I'm not going to drill down on it because that's not the idea of this chapter. But let's say this is a more advanced topic. Let's say, and this is like a true story thing. Okay, the person that's a head of lending, they said, "Lee, you know what? I want to put on a car loan sale. Okay, I want to advertise. I'm going to go on billboards. I'm going to take some radio time. I'm going to advertise, and we got a car loan promotion. And come on in, and the rate is cheap, and we're gonna, we'll finance, we'll take care of everybody, all that stuff. Okay, all the glitz of marketing. So the head of operations is listening to this at a meeting, and it was wait a minute, and the CFO is like, well, how much? What do you think you're going to loan out? Well, I don't know, but I might loan out $10 million on this car loan promotion that's going to last 90 days. And we're going to promote the hell out of it. So marketing is involved too. Guys, what would happen the wrong way is somebody would say, well, I'm gonna do a CD promotion as well. I'm gonna try to get in a lot of CD money, certificate of deposit money, so lending could loan it out. Okay, so then what is the term? What should be the term of the CDs? Somebody would say, well, 5 years. I need the money to loan out $10 million for 5 years. And they would be wrong, because what you need to do is put out a loan term of 5 years, and then you borrow money for 2.5 years, because that's when you're going to get the money back to pay the CDs back to the people, your depositors. So you see what happens is you have to match the durations. You can't match the terms, or you would have a mismatched balance sheet. Your cash flows would be off. You would see that when you go through your quarterly reporting and your shock test. People would be standing around shaking their heads saying, I don't understand. Why is our what's called the gap ratio? Why is the gap ratio so wide? And that's not good. It means you have mismatches in your assets and liabilities, in the durations. So that would cause a problem. So imagine that you sold a bunch of 5 year CDs for people, and you got your money back in half the time from your loan portfolio. But wait, you can't mature those CDs. They're out still for another 2.5 years. So that would be a mess. And basically all of the money from that you loaned out, the 10 million, would have been received already. So that could be a mess if interest rates start moving around. That's why I want to emphasize very specifically, that's why you match durations on your assets and your liabilities. What would be a liability? Your deposits. What would be an assets? Bonds, investments, loans. All of your loan portfolio, think about those as bonds that just pay differently. So this is where I need to keep saying duration is where it's at. And I'm going to pause this, go back to the book, and this is why it's like that. All right, hang on. Okay, we're back. So as that's why duration is brought up in a financial institution course, and that's why it's so important, based on what I've told us just a few minutes ago, a few seconds ago. Okay, so modified duration is a duration measurement of a bond or bond portfolio can be modified to estimate the impact of a change in the prevailing bond yields. Okay, the modified duration is duration with an asterisk on it is the present value of the present value of the duration. Okay, and you would call that modified duration. What's the idea? The idea is to say, well, a modified duration can be used to estimate the percentage change in the bond's price in response to a 1% change in the bond yield. So if your required rate of return has gone up or gone down, what we would want to do is calculate a new duration, right? Say in the modified duration, and we would use that as an extra tool. I know this gets deep, guys. If you've never seen this before, it could get confusing, and you could play the tape back. But it is giving you data about how long is it going to take to get your money back, and that's key in a financial institution. And then number two, it can change. You're seeing how much the bond's price can change, the change in the value of a bond price. So imagine if we had to calculate all this stuff, it'd be very cumbersome. Spreadsheets are wonderful. Once you get your spreadsheet set up, you leave it like that because you want to use it time and time again. So it's you're seeing here, let's say, modified duration estimates. If a 1% point increase in the bond yields from 10 to 11% would lead to a 7.27% decline in the price of a bond. So you got very specific information here. Okay. Uh, so bond X and a 10.9% decline in the bond price of bond Y. So that's what this is trying to do. And I just need us to be somewhat familiar about the conversation of it, not too deep, but I can ask us about duration, understand why it's so important, and it's going to lay a foundation for, I think, chapter 19 as we go forward. Okay, so say they're saying, well, what would be the equation, simple mathematical expression relationship discussed? The percentage change in the bond price for bond X for an increase in the yield of 0.2 percentage points. So, it's got a mathematical construct so you can see what impact rate changes are going to have on the portfolio, the bond price, and what? And the duration. All right. And if you want to go one step further than duration, calculus is required, and it would be what's called bond convexity and concavity. So it's saying a more complete formula to estimate the percentage change in the bond price. That's what this is, guys. The calculus is at play because it really people would draw a linear relationship between bond yields uh, in the market with changing rates, but they don't change like that. It actually changes in somewhat of a curvature. So the calculus is calculating points of tangency where these two are getting very close. And when you get to the extremes, they tend to move out further. Well, if you had, long duration or long term investments or loans, and that's why we preach in all the finance courses. That's why banks are all too happy to loan you money on a house loan, but then they want to sell it. It's like this will blow your mind if you got a bunch of long dated real estate loans and interest rates start to move around. I mean, the durations are long. How long is it going to take somebody to pay you, what they borrowed for the house loan? On a 30-year loan, it might be, 15, 16 years. And that's okay. But imagine, the Fed raises rates by 5% in the course of about 15 months. So it makes a mess out of your balance sheet very quickly. What do you call that? Convexity. The other one is concavity. And it's calculus to do those, believe it or not. That's exactly what that is. All right. All right, we can come off of that. I know your head's probably exploding. It's exhausting. So bond investment strategies, guys, I do want to go through these, and they're very easy, but think about these. This is far more relaxing a conversation than we were having, and this about wraps up chapter 8. But a matching strategy, just help me read through. Some investors create a bond portfolio that will generate periodic income to match their periodic expenses. For example, an individual investor may invest in a bond portfolio that will provide sufficient income to cover expenses after retirement. Because when I was a broker, I had people say, "Put me together a bond portfolio," and I know that the bonds pay every 6 months. So I want you to buy me a bunch of bonds, making sure I get coupon payments every month. Well, I'd have to buy several different bonds, right? Some that had a January payment and a July payment. Some would have a February payment and an August payment. And you go through matching that up for somebody to say no. And the person's like, no, I want, here's $100,000. I want 100 bonds, and I want them broken up into those increments. And I want to make sure I'm getting paid every month. I don't want to wait 6 months and get a big chunk of money. I want to get paid an incremental amount monthly. So that's a match. Okay. A laddered strategy is if you are buying bonds, uh, laddering them out. So somebody would say, well, let me buy some 2-year bonds and then put some more money in 4-year and then put some money in 6-year and 8-year. You see where we're going with this. And in 2 years, these mature. So then I'll put these at the end. I'll put those in, let's say, 10-year. That's a ladder. It looks like a ladder when you're constructing it. So again, when I was more practicing that, we could do this at work, but you had people if you're a broker, a retail broker, you'd have people calling, or even a commercial broker. You'd have people calling saying, "Look, I got $1 million. I need you to ladder these out, and every 2 years, or every year, or every 6 months, whatever they want the ladder to look like, you would have maturities in those ladders, in those rungs." And it's just they're never far away. And the idea would be the further you go out, you're getting a better interest rate, right? But as when you set this up, they're never far away from some cash flow if they need it. It might be a year, and they got bonds maturing every year, and then they could either put them at the end or just keep the money, spend the money, or whatever they're doing in their life. But that is a ladder strategy. All right, barbells. That looks different. That would be somebody buying a ton of bonds here at, let's say, a 2-year maturity, and they're going to wait and they're going to buy a bunch of bonds here at a 10-year maturity. For whatever reason, that's what works for them. And it looks like a barbell. It looks like they got two big ends and they don't have anything in the middle. They're just collecting their coupons, but that's what that would look like, a barbell strategy. Okay. The last one, interest rate strategy. With an interest rate strategy, funds are allocated in the manner that capitalizes on interest rate forecast. So you go out on the yield curve and you're buying with particular rates, and that would be kind of that ladder strategy, like I was mentioning. The longer you go out, you should be getting paid more. So a lot of people will do that. Well, but I got to keep a little liquidity up front, but I want to ladder that out and get paid more. But I'm focused on what the coupon rates are going to be as I am making those investments. Okay, so the valuation risk of international bonds, guys, you have one more thing. I'll just say this, and we'll wrap this up. Anytime you go outside of the country, if you're dealing with other currencies, and I travel fairly often, so I'm dealing in various currencies. You got pretty much all of Europe that has gone to the euro. But if you go to Turkey, if you go to Russia, if you go, you go to many of these countries, they don't even in the European zone, they keep their own currency. So if, they've separated from the euro and never did embrace it, and Turkey uses its own currency, Russia uses its own currency, several countries in the European area. Then, of course, if you go in the other way, if you're going west, They don't have a euro in China and Indonesia and Singapore. They have their own currencies, and they are fluctuate. If you go south, all of South America, they have their own currencies. So if somebody is investing a lot in international investments, they really have one more thing to worry about. If they have the country risk, meaning political, how is the country being run that could affect bond prices and yields? And then they have the currency risk. If everything is going smoothly, the currencies are changing almost on a daily basis, per second basis, and you have to worry about if your asset is being undervalued. If the euro starts to weaken, then you have some deterioration there. But let me see, that's all I want to worry about in the international sphere. Yeah, that's it. I'm not going to go much in international. The things that I said are plenty. Okay, guys, so I will conclude the video now and post it to YouTube. And thank you for listening.